Jeffrey Gundlach, I appreciate you being with us. It's great to catch up with you, especially now, given what's been going on.
I think we're now priced ultimately for a terminal Fed funds rate of around 1.5, maybe 1.75. My suspicion is they're going to keep raising rates until something breaks, which is always the case. What's been feeding everything is the stimulus. I think the Fed should have stopped quantitative easing not yesterday, but a year ago. And what we're seeing is the consequence of all this excessive stimulus. A 5 handle on the CPI, well, it's now 7.5. 7.5 sounds like we're headed towards double digits. I feel young again because I grew up with Jimmy Carter. I mean, interest rates are so incredibly low. They're super negative on a real basis. They were super negative on a real basis on Jimmy Carter, but they were at much higher levels. So it's not surprising that markets are having trouble because they've all been predicated on the enormous stimulus, which is obviously being taken. But that's a big fiscal drag. The fiscal drag with the consumer not having stimulus, I think the probability of weaker economic activity later this year is pretty high. I feel young again because I grew up with Jimmy Carter. One thing we can all agree on is inflation just continues to surprise on the upside. Treasury rates have been rising, and bond returns were negative last year, and they're more negative this year. And so people don't like buying things that are delivering negative returns. And so one has to ask, when the Fed is not buying any bonds anymore, and when they start doing quantitative tightening, what's going to stop prices from going down on some of this credit product? Massively negative interest rates, more negative than under Jimmy Carter. No one's making any money. No one's making any money. No one's making any money. I feel young again because I grew up with Jimmy Carter. The median home price in the United States is up 30% over the last 2 years. On the CPI, the shelter component is grossly understated versus what's actually happening with rents, which are up double digits. So there'll be a rotation of what's driving the inflation. We think that inflation is very likely to print at least 5% for 2022, which is way less than 7.5, but it's a great distance away from a 2%. Every indicator, we have a litany of them at Double Line, suggests that the 10-year Treasury under normal market conditions should be probably 100 basis points higher than it is right now. So interest rates are going higher. Every risk asset has to reprice based upon these higher interest rates, and it's a process where capital preservation becomes important. I haven't bought emerging market equities yet, but I'm getting close. It's okay to start averaging in. Beyond that, the dollar isn't even weak yet. But once it reverses, and it will, you're going to see the real, the bumper crop of performance from these European stocks versus US and emerging markets. This is the main trade. You look at the United States, growth versus value. And value is as cheap now as it was in 1976 versus growth. I feel young again because I grew up with Jimmy Carter. I'm not really a big fan of commodities right now, not until the dollar starts weakening because they're up so much. No one's making any money. No one's making any money. I feel young again. I feel young again. I grew up with Jimmy Carter. I feel young again. What's been feeding everything is the stimulus. Feeding everything is the stimulus. My suspicion is they're going to keep raising rates until something breaks, which is always the case. I feel young again. I feel young again. I feel young again. No one's making any money. No one's making any money.